Hello, everybody. Thank you so much for joining me today. We're going to be changing things up actually for today's episode. What I decided to do is try something new, and in this video, I'm just going to be talking about stocks. We're going to be talking about different investing strategies when it comes to the stock market. In tomorrow's episode, we're going to be talking strictly about sports, and then the video after tomorrow, or the day after tomorrow, we're going to be talking strictly about stupid shit. And I just want to try something new, see if you guys like it. Let me know in the comment section below if you think this is a better way of doing it, separating the three categories, or maybe just the way I was doing it was perfectly fine and I just got to get back to that. Let me know. I have no problem either way, whatever accommodates you guys. But let's get into today's video. I'm going to be discussing different strategies that people use when it comes to investing in the stock market. Because really investing in the stock market is all about having money make money for you while you're sleeping. That's really the goal of it. Whenever someone invests in the stock market, you don't get into the stock market hoping you lose money. You're always hoping you make money. And I think the stock market is a great opportunity to do that. And there's so many different ways to go about it and to make money. It's unbelievable. One of the ways to do that is called technical analysis. So the way technical analysis works is what you do is you use the TD Ameritrade. Well, this is the most popular one. You use the TD Ameritrade platform. There are other platforms out there, but that's the most popular one. And when you go on there, you type in a stock like, let's say, Apple. And when you type in Apple, you see all these green and red little square symbols, and you see these lines that go through it. You know what I mean? It shows the stock, going down for red, and when it goes up, it's green. So it's just a little like bar charts that go up and down based on volume, how the stock's doing, if they've reported earnings and the stock went up or down and stuff like that, or news that's going on in the stock, or even just a sell-off. Maybe there's a stock that people are just buying, and then something happens and a lot of people sell off their stock, and then you see the stock go from boom to boom. So that's all technical analysis is. When technical analysis, what you're really looking for is you're looking for dips. So you're just looking for a U shape where you see the U, you have half of the U, then you see it connect to make the rest of the U, and really you're trying to buy not on the exact dip, because you don't want to buy if it's still the stock's still decreasing in value. But technical analysis look at when it goes from half a U to almost a full U, and that's when they buy, because what they do is they kind of look at 180-day analysis, maybe 3 months out analysis, 90-day analysis, and they know trends. Trends is a big thing with technical analysis, because you're basically just trying to recognize patterns and understand them and know when the best opportunity is to invest your money in a stock and then get out of the stock. Now, a lot of technical analysis are short-term traders, which is another type of trading philosophy. And basically what a short-term trader is they're looking to get in the stock and then get out of the stock quickly. So this is a little different than being a day trader, which I'll get into next. Because if you're a short-term trader, you're going to hold it for more than one day. So a short-term trader, invest in, let's say, Under Armour, the shirt I'm wearing, the company, and they're like, okay, I see that this company has a drop, if there's an opportunity here, I'm gonna buy shares at, let's say, $15, and then I'm gonna sell out when it gets to $16. So they at $15, they're like, okay, I see the validation, it's going up again. I'm gonna throw $10,000 in at $15. And then once it hits $16, I'm just going to sell, because, it looks like from the trends that once it hits $16, it tends to go back down afterwards. And that would be like a technical analysis short-term trader. You might hold a stock for, a day. You might hold it, for a week or a month. But you're not really going to be holding that more than, 6 months or a year. You're really not if you're a short-term trader. You're trying to accumulate a lot of cash quickly. That's basically what you're doing, being a short-term trader. And you don't even need to use technical analysis to be a short-term trader. You could just, a company reports earnings, huge dip in the market, and you could just buy it. invest like $1,000, $2,000, $10,000, and then just buy it and just say, okay, when this goes up, 5%, I'm just gonna sell, make like a couple $100 and then move on to the next stock. But let's get into day trading. So day trading is really popular for people because it's the most popular, but it's also the most risky. Because if you're a day trader, essentially first of all, to be a day trader in any brokerage account, you need to have a minimum like $20,000 in your account sitting there to cover like losses, and just that's a federal government law that you need that much money in your brokerage account to do day trades. And a day trade is just you buy a stock at 9:30 a.m. right when the market opens, and then you sell that stock at 10 a.m. So in that same day, you bought and sold that stock. Now, a lot of people that are day traders, they buy penny stocks. And penny stocks are any stock that is $5 and under. Super risky to get into penny stocks. But the reason why people like penny stocks is because, one, they're cheap, so you can buy more shares. And two, if you buy a penny stock at $2, and then in an hour it goes up to $3, and you just invested $1,000, that's a huge profit margin. And that's why people like it, but at the same time, you can lose your money just as quickly. So if you buy a stock at $2, and then you throw $1,000 in, and then an hour later it goes down to $1, well, you just lost a lot of money. And that's the problem with penny stocks is, penny stocks are not reliable, reputable companies. They're not companies that, pay dividends or, are like, have like profits and, that are like great companies. They're not established companies. But the opportunity to make really quick money, if you understand the business, if you understand that specific penny stock, makes it interesting. And a day trader doesn't necessarily just do penny stocks. They could buy Tesla, at like $300 a share and be like, oh, like Tesla's, today I think they're going to go from opening at 300 all the way up to 350. And then, sell at 350 and make a bunch of money, But basically a day trader, you just buy and sell the same day. A short-term trader, you buy and hold it for more than one day, usually not more than 6 months. And then a technical analysis trader is someone that basically looks at the trends of that stock from a 180-day analysis or, maybe a 2-year analysis, and just notices when the stock, hits its, highest point, and when, we think it's going to hit its lowest point and go back up. And those are 3 of the ways, and there's actually 2 more ways I haven't even discussed yet. And these other 2 ways are long-term investing. And then the other one is long-term investing. Let's get into long-term investing first. So long-term investing is essentially, you love a company, you did all the research on that company, you read their annual report, you listened to the conference call, you looked on what the company sells, like upcoming products, everything about the company. You love the company, you invest money, and you say, I'm going to buy this stock at, let's say, $28 a share, and I'm just going to hold it for, 3 to 4 years, because this stock is just going to grow and grow and grow. And, I got in at $28, and I see this stock going up to like $75 in 3 to 4 years, and I'm going to, hopefully that stock has a dividend. I'm just going to collect that dividend check, watch the stock go up, and make a bunch of money, and then sell in 3 to 4 years, and then do the process all over again. And that's essentially what a long-term trader is. It's a very popular way of doing it. It's a very safe way of getting in the stock market. And the only thing when being a long trader is you have to do your research more than probably any other type of stock market like investor. You definitely want to do your research, big time when you're a long-term investor, just because you can also, buy those shares and it goes down, and that's over time. So then you're just losing money over a long period of time, which is not good. And then the last way of doing it is long-term investing. And this is Warren Buffett's philosophy. So Warren Buffett's philosophy is long-term investing. Basically, he only buys companies that, one, here's a great example. He owns a shit ton of Coke. And he's owned Coke stock forever, for like 40 plus years. And companies that he buys are companies that he knows are going to be around 20, 30, 40 years from now. That's the companies he buys. This guy, Warren Buffett, reads religiously, 5 hours a day. He does a lot of research. he owns a lot of companies under his Berkshire Hathaway company, you know, like Spalding, Dairy Queen, you know, different companies like them. I think Geico also. And basically, like, his philosophy is long-term investing. Like, I'm going to buy the stock and, you know, I think this company is going to last 20, 30, 40 years, and I'm just going to hold it, and I'm just going to let it grow, and I'm going to, like, keep buying stocks whenever I have, you know, money to invest in that company. I'm just going to watch it grow, and then, you know, 20, 30, 40 years from now, I'm going to, you know, I'm either going to hold on to it because, you know, I want to keep watching it grow, or I'm just going to sell it, you know, and be a millionaire. But the only problem with long-term investing is, since, like, Warren Buffett was able to do it because, you know, now it wasn't as tech savvy when he was started investing as it is now. I think it's much more easier now for companies to get knocked off because of technology. So I feel like long-term investing is, for me personally, this is just my personal opinion, it's not the best strategy to use, just because of, you know, all the technology advances that have been going on and will continue to go on. And it's just going to change the way, you know, companies run, and it's going to knock companies off quicker than ever before. So it can have risk, you know what I mean, but, you know, it can also have high reward. So basically what we covered in this video is different strategies for investing in the stock market. We talked about technical analysis, short-term trading, long-term trading, and long-term trading, and also day trading. So that's 5 different ways of investing. And, you know, that's not even including, you know, call options, which we're not going to get into in this video. But you can call on, what call options kind of are, or stock options is basically you put money in for a stock and you predict that's either going to go up or down in a certain amount of time, and then that option expires. But we're not going to get into that today. But that was just 5 ways that I just mentioned of investing in the stock market. There's many other ways, but, you know, those 5 are the biggest ways of doing it. Another way, you could also invest in index funds, like the Vanguard Index Fund, a very safe way of investing in, you know, a bunch of companies all in one, you know, index fund at discounted price. But let me know what you guys think. Did this video help you guys? You know, did you guys, you know, learn something valuable? Do you like this new format of, you know, me talking about one subject each day? And I'll see you guys tomorrow when the sports section. And thank you so much for joining me again. I really appreciate it, and I hope you guys have a phenomenal day. Have the best day of your life. Thank you.